Hello, welcome. Thank you for joining me today. My name is Gail. If this is the first time you're watching one of my videos, please go to gailmarie.org for more information about myself and the series of free bookkeeper training videos. Let's get started with number one, reading and understanding financial statements. This is the most important one. It's the foundation that all of the rest will be built on. So let's get started. What are financial statements? Financial statements are simply a balance sheet and an income statement. Now, sometimes there are more statements and we do use different titles, but we're just going to keep it easy. We're going to cover those in a later video, and we're going to start with the balance sheet and the income statement. So the balance sheet is the financial position of a business on a particular date from the beginning of time. It consists of three different sections: assets, liabilities, and equity. Assets are cash or anything that can be turned into cash fairly quickly. Liabilities are the debts the business owes. A memory key here for you is liability sounds like lies. Lies are bad, we don't want those. Debts are bad, we don't want those either. Equity is just the difference between assets and liabilities. So assets minus liabilities equal equity. Equal and equity both start with EQ, so there's another memory key for you. Now, equity is the owner's section. So if he were to sell off all the assets, pay off all the liabilities, what is left over would be his to take home. All right, now I want to show you something to help you see this. It's simple math. If we have 10 minus 6 equals 4 and we want to check our answer, we add 6 and 4, right? Boom, we know we're right, we're in balance. Well, the balance sheet works exactly the same. Assets minus liabilities equal equity, therefore liabilities plus equity must always equal assets. That's how we know that we haven't made a mistake and we are in balance. All right, so let's get started with a couple of examples. This is Jack. Jack is a carpenter. He has decided to open his own business. He's going to refinish furniture, he's going to build furniture for resale, and he's also going to buy some furniture for resale as well. But just to get started, he's going to offer services first and grow into the other areas. And he's also working by himself as a sole proprietorship. So this area later will change in different videos as he brings on partners and incorporates. Okay, so Jack came to me and he said, Gail, I've opened a business checking account. I took $10,000 from my personal savings account to do this. I want you to handle all of the daily transactions for me. Okay, great. So we know that he has $10,000 in his business checking account. So the balance sheet and the income statement actually just shows all of the activity from your business. We get it on paper so we can summarize it to use as a tool in our business for making decisions. Okay, so we know we need to get $10,000 cash in the operating account on the paper. $10,000 goes here. That's the first side of our transaction. Now, something you need to know, every single transaction has two sides. There is no exception to that rule. We have to have two sides to every transaction. And of course, in this case, the other side of this transaction has to go down here in order for this to work, for our statement to be in balance. We know he took the money from his personal savings account, so we're going to book it to owner's contribution, $10,000. Perfect. We have 10 here, we're good. Now let's go on with another example. He did a refinish for a customer. They picked up the furniture and paid him cash on the spot. He took the $500 down to the bank and made a deposit. All right, so we know we're going to increase our bank account $500. We know he has $10,500 in the bank. So our total assets now become $10,500. We need the other side of the entry to go down here. Well, this is where the income statement comes in. The income statement records sales less expenses equal the net income. Now, something to note about the income statement, the balance sheet is from the beginning of time, but the income statement only covers the current year. And our current year is normally January through December. There are others, but again, we're going to cover those in later videos. So this particular income statement is for the one day ended September 15th, 2016, because Jack just opened his business. So we're going to come over here for the other side of the entry and record that 500 in the refinish sales account. 500. So our gross income is 500. So we don't have any expenses yet, so our total net income is 500 so far. This 500 flows to the current net income over here on the balance sheet. 500, that's how these two go together. So now our total equity is 10,500. We have 0 in liabilities, so our total liabilities and equity is 10,500. Our bank balance and the only assets that we have, our total assets are 10,500, so we are in perfect balance. All right, now let's go on to his next transaction. Jack received a credit card when he opened up his business checking account. He received a business credit card and he wants to use it. So he went down to the supply house and he made a $100 supply purchase for the shop. He brought us back the receipt. We know that we need to get this booked. He owes the credit card company $100. So we know one side of the entry goes here. Our total liabilities are now $100. The other side of that entry is an expense, so it comes over here to the income statement under the supplies account, $100. Our total expenses so far are $100, so our gross income was $500 minus $100 equals a $400 net now. That will flow through to the to the balance sheet, $400. Our total here now is $10,400. 10,400, 100 equals 10,500. Boom, we're still in balance. Now I'd like to explain something here. If you notice, I have gross income and then we have net income. So something to help you, gross income starts with GR, gross is greater than net, greater starts with GR. So hopefully that'll help you remember. Gross comes first, then your expenses are deducted, then we have net income. All right, let's move on to another example. Jack received the electric bill and already it's $200 on his first day. So he has to pay that $200 electric bill and he wrote a check for it. He wrote a check for it. Now we know his bank account is going to reduce down to $10,300. The other side of that entry is going to be over here on the income statement in the utilities account. So we're going to book $200 as a utility expense. Now his total expenses are $300. $500 gross minus the $300 expense equals a $200 net income. Now he's down to just a $200 net income that's going to flow through to the balance sheet right here. 200 plus 10,000, our total now changes to 10,200. 110.2 equals 10.3. And that ties up here. Didn't change this one. Our total assets are now 10.3. So 10.3 and 10.3. So we have 10,300 in total assets minus the $100 liability equals the $10,200 in equity. $100 in liabilities plus 10.2 in equity equals 10.3 total liabilities in equity. Perfect. That's all there is to the financial statements. Isn't that easy? So now these are going to grow as we go, so hang in there. We're going to go through some really good transactions. We're going to add employees. We're going to buy equipment. We're going to take out loans and set up notes. So this is going to grow and grow and grow, and you're going to learn so much. All right, there is one last thing I want to go over. Since we discussed the income statement being for the current period, at the end of every year, you're going to close out your income statement so you can start a new year fresh. Well, to do this, we zero out the sales and the expenses. We're going to zero out this current net income, and that means we have to move it someplace else. And where we want to move it is to accumulated earnings. So all we're doing is just moving it. It's not going to change. The total is still going to be 10,200. So we're going to close out our current net income to accumulated earnings at the end of every year, and hopefully the accumulated earnings will keep growing and growing and growing.